Welcome to this month's tax tips. With the 5th of April fast approaching, this month we're going to look at some pre-year-end tax planning measures for individuals. The three areas for us to consider are income tax, capital gains tax and inheritance tax. Jumping straight into the income tax side of things, the big change approaching on the 6th of April 2022 revolves around the social care levy. Now, the social care levy is going to add 1.25% to employee national insurance contributions, and it's also going to add 1.25% to employer national insurance contributions. Now, the government didn't want small business owners to miss out, and knowing that they often pay themselves a very small salary that doesn't attract any national insurance and take the vast majority of their remuneration as dividends, they've helpfully increased dividend tax rates by 1.25% as well. Now, just to recap on how the current system works, the first £12,570 of any individual's income is tax-free because of the tax-free personal allowance. Where you are taking income in the form of dividends, then the next £2,000 is also tax-free by virtue of the dividend allowance. The next £35,700 of dividend earnings are taxed at 7.5%. If you're an employee, that's the bracket in which you are paying 20% income tax. Of course, you don't get the dividend allowance if you're an employee or paying yourself through PAYE, and therefore £37,700 of your income is taxed at 20%. The next £49,730 of income is taxed at 32.5%, or if you're an employee, PAYE earner, it's at 40%. Now that takes us up to total earnings of £100,000. Once you go above £100,000, you start to lose your entitlement to the tax-free personal allowance, and that erodes at the rate of £1 for every £2 you earn above £100,000. So rather than having a new tax threshold, there is simply an effective rate of tax for earnings between £100,000 and £125,000, which on dividends is 40% and on salaried earnings is 60%. Once you've got through that tax bracket, the next £25,000 of earnings is subject to 32.5% on dividends, 40% on PAYE earnings, and that takes us up to total earnings of £150,000, above which on dividends you will pay 38.1%, and on employed PAYE earnings you'll pay 45% income tax. Now, obviously with the social care levy, these rates for dividend taxes are going to increase. So the 7.5% rate will go up to 8.75, the 32.5% rate will go up to 33.75. You get the idea. I won't go through them all. In terms of trying to mitigate that, first of all, small business owners might be saying, well, should I continue to pay myself in dividends, or would it be more tax efficient to revert to being on the payroll, paid as PAYE? Well, because of the change, not just to dividend rates, but also to national insurance, the overall effect is relatively minimal. And if it was more tax efficient for you to take dividends in this income tax year, then it still will be next year when these new rates apply. In terms of trying to mitigate the increases, the first thing to do is to consider whether it's appropriate to accelerate some dividends into this income tax year before the 5th of April 22 and pay the lower rates of dividend tax this year rather than paying something next year. That's probably something that'll apply if your earnings are currently less than £50,000 and therefore you're in the lower rates of tax. You might want to take your dividends up to the £50,000 higher rate limit to bank that 7.5% rate this year. Might also apply if you're a higher rate payer. You may want to take your earnings right up to £100,000 and bank the rates this year. But generally speaking, it's probably worth taking some advice before committing to accelerating any dividends. Other things you could consider, personal pension contributions would extend the thresholds at which higher rates of tax apply. So at the moment, as we said, Once your earnings go above £50,000, you start to pay the higher rates of tax. And once you go above £150,000, you start to pay the top rate of tax. If you made a personal pension contribution, let's say £10,000, then you get tax relief putting that money into your pension. So you put £10,000 into your pension, the government tops it up with a 20% tax relief, and therefore £12,000 is credited to your pension. Well, the thresholds that you pay tax at are therefore increased by that £12,000, and so the £50,000 threshold suddenly becomes £62,000, which may be helpful going forwards. You can also consider making gift aid payments if you're feeling particularly charitable at the moment. Gift aid payments work in exactly the same way as pension contributions. So if you made a £10,000 gift to charity and it qualified for gift aid, the charity get £12,000, and your basic rate band threshold again is moved from £50,000 to £62,000. Moving on from income tax, the capital gains tax annual allowance, everybody receives £12,300 allowance. If you crystallise any capital gains within an income tax year that are £12,300 or less, then no capital gains tax applies. This is a use it or lose it allowance. So if you don't use the allowance this year, it doesn't roll forwards. You get the same allowance again next year, but it's still only £12,300. So how do you take advantage of it? Well, it's quite difficult. Obviously, if you haven't got anything to sell, then there's not much you can do. But for individuals with share investment portfolios that are pregnant with quite a lot of gains, you might want to consider crystallizing some of those gains within the portfolio. You could sell some of your shares and within various time restrictions, potentially buy them back. You do have to wait more than 30 days to buy them back. Otherwise, some anti-avoidance legislation kicks in and stops you crystallizing the gain. But otherwise, you might want to consider selling some of your stocks to realise those gains now and use up your allowances. For investors, those of you who invest into ISAs, there's an annual investment allowance of £20,000. You can only put 20 grand a year, put £20,000 a year into an ISA. If you've maximised that, or if you like to maximise that every year and you haven't yet done so, best to do that before the 5th of April. If you're investing in ISAs for your children, then the maximum you can invest per child in any given tax year is £9,000. Again, worth looking at that and deciding whether you want to max that out this year. Moving on to inheritance tax, there is an annual gift allowance of £3,000. That's in total per donor. So if you're looking to give cash to your family, then overall you can give £3,000 a year, and that immediately comes outside of your estate for inheritance tax purposes. Again, that is something of a use it or lose it allowance. You can't accumulate the £3,000 allowances forever. They do allow you to roll forward 1 year's allowance. So if you didn't do it last year, you could potentially put £6,000 of gifts together this year and give them to the lucky beneficiaries now. But otherwise, if you don't do that, you will start to lose them. There's the small gift allowance. Now, this is unlimited per person, so you can give a £250 gift or up to £250 of gifts to as many individuals as you wish. And finally, for inheritance tax purposes, there is the regular gifts out of income opportunity. This is a bit of a more complex area, so again, it might need advice and planning if you want to implement it. But fundamentally, if you are in a virtuous position where you have income that exceeds your outgoings and therefore you are accumulating wealth, perhaps in your retirement or close to retirement, you can consider gifting part of that income that is simply accumulating in your bank account to members of your family. And if they are regular gifts out of excess income, then they immediately fall outside of your estate for inheritance tax purposes. So this month's quick tax tip applies to business owners and is focused on company mobile phones. We come across quite a lot of confusion in this area, in that often employees or business owners have their own personal mobile phone and want to bill the cost of that to the company. Now, there's two very contrasting tax effects of doing that. The first is if a company takes a contract for a mobile phone and gives it to an employee or a director, then there's no taxable benefit arising on that occurrence. The individual concerned can use the phone privately and for business use. You don't need to monitor the amount of private use. There's no taxable benefit and everything's fine. The company gets a corporation tax deduction for the cost of the mobile phone. If the director or employee has their own mobile phone and is trying to pass the cost back to the business, then the business can't simply meet the mobile phone bill, or if it does, an income tax benefit will arise. What should happen in that case is that the employee must get an itemized bill, highlight all of the calls that relate to business, and only claim for those calls. Now, as you can imagine, that will be a very onerous task. Not very many people want to do it, and it's a bit of an area that can trip you up in the event of a HMRC inspection. So it's always best, and our advice, to make sure that company mobile phone contracts are taken out and mobile phones are provided to employees, to cut down on the bureaucracy of having to assess bills, and also to avoid any income tax pitfalls.